Lee, let me ask you. You have been concerned about the market and the heights of the market for some time. You've been warning that things could take a turn down and that you are less optimistic than others. We keep hitting new highs, and I just wonder when you think things would potentially be offset. I know you're still not convinced that good times are here to stay.
Yeah, well, I'm very concerned about two things. One is the debt buildup. We have two candidates running for office. Neither one talks about the deficit or the buildup of debt. In 2017, I think our national debt was $20 trillion, and 7 years later, it's $34 trillion. That's a growth rate far in excess of the growth rate of the economy, and that's going to be a problem one day. We don't know the day, but it's going to be a problem probably when we least expect it. And secondly, I would say, what's kept me involved in the market is if the 10-year bond belongs at 3.76 where it is currently, there's very little in the market that's overvalued, unless the 3.76 is reflective of a coming recession. And if it's 3.76 ex recession, there's very little that's overvalued. I go back to 1972 Nifty 50 when the market is selling at a much bigger multiple than it's selling at now, and the 10-year government bond was 6.5%. And in 2000, Cisco, which was the then present day NVIDIA, was selling at 380 times earnings. The 10-year government in 2000 was also 6%. So at 3.76, there's nothing that's overvalued, or very little that's overvalued.
So has the Fed cutting rates pushed you into a position where you're going to be putting a lot more into stocks?
No, I'm reasonably fully invested, but I'm invested in off-beat merchandise. I have a 20% position in a bond that I think the government's behavior is disgraceful. I've discussed about it before. It's a little complicated. I have about 15% energy. Given what's going on in the Middle East, I would think energy would be a place to have some money. And then I have a lot of special situations. So, I'm not sitting on a lot of cash. And I think the Fed cutting rates is cutting rates in the short end. And I think the long rate is going to go up. The 10-year rate is going to go up as the Fed reduces short rates. So you get back to a positively sloped yield curve.
Does it make sense to you that the Fed cut rates, just looking at where you see the economy?
Yeah, I would say that the short rates are too high relative. Historically, the 10-year government bond is yielded in line with nominal GDP. So if you have real growth of about 2.5%, you have inflation of 2.5%, that would be 5% nominal GDP. So the 10-year would not be overvalued at a 5% yield. And it wouldn't be undervalued. I think the rates are going to go higher. In the short end, maybe you get 125 basis points over inflation. So the rate doesn't belong at the current level of 5%. So I think that the Fed will cut short rates, but it's not going to make much of a difference. You don't use a short rate to discount a long duration asset.
So your concerns about when we will have a problem on our hands just in terms of when people won't buy the government debt. As you said, it's probably coming at the time we least expect it. How do you prepare yourself for that?
Well, I think, look, I may be too old. You take me out behind the barn and shoot me. I'm 81 years old. I've been through a couple of, bubbles, 2000 bubble and the 1972 bubble. In a bear market, he who loses least wins. So I would think that it's going to be hard to prepare, though I think stocks are the best place to be. I would avoid bonds. And you just don't know the timing. In 1972, two very civic-minded citizens, Pete Peterson and Henry Fowler, used to run full-page ads in the Journal and the Times, alerting the public to the evils of the budget and trade deficit. And here we are, 50 years later, and the only significance has been that we have the lowest interest rates in our lifetime. Now, I don't think it's sustainable. We had in the 70s the concept of guns and butter. We have guns and butter now. We're assisting in fighting two wars, and no one's focused on reducing the deficit. And we're going to ultimately have crowding out. That's my view. So I'm very concerned. I'm concerned about the election outcome. We got two people running for election. I don't hear either one of them talking about the need to deal with our fiscal issues. You know, we got to finance these wars. We're not thinking about it. And whether the market forces us one day, who the hell knows? But I think it will. And so that leads to my conservatism. Not outright bearishness, but very conservative. I think the market at 21, 22 times earnings is fully valued and does not allow for the uncertainties that exist. That's my view, but I'm finding plenty of things to do in the market. I'll be honest with you. I find plenty of things to do. But everything I look at leads me to be cautious. You know, everybody talks about stock repurchase. I would just observe what the wise man does in the beginning, the fool does in the end. How many billions of dollars of stock do you think Intel bought back? How much billions of dollars of stock did Bed Bath & Beyond buy back? You know, Intel is now on government assistance, and Bed Bath & Beyond, the great retailer, is in bankruptcy. So there's no magic. You know, you only make sense to buy back your stock if it's cheap, and if you're so far into a bull market, maybe your stock isn't cheap. Maybe you're making a mistake.
Lee, why don't we talk about the things you are finding to do? If you've got 15% in energy because you worry what's happening in the Middle East and think that that will potentially drive energy prices higher, where are you looking? Where have you invested the most? Well,
I have two large positions in two Canadian oil and gas companies. Paramount Resources, we've been going for a while. Stock yield 7%. They have virtually no debt. They're producing oil at $31 a barrel, and they're following a strategy of increasing production. So they're going to go from 100,000 barrels a day of production to probably 150,000 over the next few years, bringing down their average cost of production. So you have a debt-free company with a current dividend yield of about 7%. You know, I find that's better than cash. And another company that is run by a very smart guy, Michael Rose of Tourmaline, you know, one of the largest oil and gas producers in Canada. Stock has a fat dividend yield of over 5%, and run by a very smart guy. And I would think that given what's going on in the Middle East, there's a risk that oil prices move higher than we think. One that I have a very big position in, but it's complicated, is a company called Legato, which I've talked about in the past.
Sure.
This is a travesty of the U.S. government in terms of their behavior. These guys have $40 billion of assets, and you can create it in the market for $1 billion. And at the end of the day, they're suing the government for $40 billion. And I think that their lawsuit has a lot of merit. And I think the bonds are totally mispriced.